In this video, we're going to deep dive into Brookfield Corporation with ticker BN and not Brookfield Asset Management, which is BAM, to see if it can be an interesting investment and if you can outperform the market by investing in this company. So about the business, now the market cap is around $93 billion. The year-to-date performance is minus 0.9%. The price to distributable earnings is 17. The forward price to distributable earnings is 14. So is it a buy, or is it better to buy maybe Apollo or KKR, which are the main competitors for this company in this area, or eventually even buy BAM, okay? Compared to the S&P 500 over the last 5 years, it has done a performance of 16.9% per year compared to 15.7%, so it's a little outperformance. In this video, we're going to talk about the business. We'll dive into the important numbers, the moat, the value, and obviously some potential problems that I may see with this business and that need to be answered before considering an investment. For the history, it started in 1899. The company was founded as a Brazilian traction, light and power company limited in Toronto, Canada. This marks the origin of a company that will evolve over more than a century into the global asset manager it is today. For investors, this highlights the company's long-standing history and adaptability. In 2002, Bruce Flatt took the helm as CEO of Brookfield. His leadership tenure has been transformative, overseeing significant growth and strategic shifts. For investors, a long-term and influential CEO appointment is a critical event in a company's history. In 2015, Brookfield, as part of a consortium, acquired full control of Canary Wharf Group, the owner of the iconic London financial district. This was a significant real estate investment, underscoring Brookfield's capability in acquiring and managing large, complex assets. In 2022, Brookfield completed the spin-off of 25% of its asset management business, creating a new publicly traded entity, Brookfield Asset Management Ltd, BAM. This was a major strategic move designed to simplify Brookfield Corporation structure and highlight the value of its asset management franchise. For investors, this created a new way to invest in a pure-play global alternative asset manager. 2025, BAM announced the completion of a significant corporate restructuring arrangement with Brookfield Corporation. In this transaction, BAM acquired a substantial portion of its outstanding common share from BN. That move was aimed at broadening BAM's shareholder ownership and improving its eligibility for inclusion in major US market indices, which can impact stock liquidity and demand. This is a recent key development for investors in both BN and BAM. How do they earn money? Okay, Brookfield Corp is an investment firm focused on building long-term wealth for institutions and individuals. The long-term here is very important because it's what makes them different from other asset managers, from other companies, is really like this long-term focus. It has 7 operating segments: asset management, wealth solutions, renewable power and transition, infrastructure, private equity, real estate, and corporate activities. It invests in real assets that form the backbone of the economy to deliver risk-adjusted return to shareholders. The company generates the major of its revenue from asset management. It has a geographic presence in the UK, the United States, Australia, Canada, Brazil, India, Colombia, Germany, and other Europe, other Asia, and other countries. So with asset management, they earn fees for managing assets for their clients. They also earn carried interest, which is a share of the profit from the investments they manage once those investments achieve a certain return. They also have investment and operations. Brookfield operates and invests in several business segments generating return from these activities. Here we have real estate, renewable power and transition, infrastructure, private equity, insurance solution, wealth solution, residential development. Income from this segment will likely come from the operational revenue of the assets they own and manage. For example, rent from property, revenue from power generation, and gain from the appreciation and sale of this investment. And this is important to understand that the policy of Brookfield is we find attractive business at a discount, okay, at a good valuation. We operate them with good cost efficiency, and then we have higher free cash flow, higher return and potentially sell them when it's time to get money from it, okay? You also have some real estate. So here it's a view a bit of the real estate. You have the core real estate, which is 15 billion, transitional and development 7 billion, and residential 3 billion. Core, it's mostly like office, okay? So here you can see that the 10 premier office, main offices, okay, they have in New York, London, Toronto, other, they have an average of 94% occupancy, which is pretty good. Okay, the lowest one are the Potsdamer Platz in Berlin, which is 81%, and Canary Wharf, which is 91% of occupancy. Here's the different things that they have. We have an irreplaceable core portfolio of 35 trophy mixed use precinct with strong underlying fundamentals. So you can see that the occupancy is 96% for this kind, for the prime office, okay, and 48% LTV, 7-year lease life generally. They plan in the future to sell the TND. So the TND here is a transitional and development. They plan to sell them, okay, which is worth now 7 billion, which 91% occupancy. So I guess it's because the occupancy is too low and it's probably not making enough money for them to keep it, and they want to use this, okay, to migrate to core assets into insurance account in wealth solution, okay. So like this, they will make more money because the insurance solution is really growing fast and have a return on equity between 15 and 20%. Here you can see the different area from sales that I picked from Google Focus. So you have private equity, infrastructure, asset management, etc. It's not exactly true because it's a bit strange to analyze. But I hope you will see more clear in this business at the end of this video. Who has the clients? So you will have institutional investor like pension fund, sovereign wealth fund, endowment, and foundations that allocate significant capital to alternative investments, insurance companies looking for long-term stable return to match their liabilities, wealth fund and family office, high net worth individual and families seeking diversified asset management, public and private investment funds that invest in Brookfield various investment vehicles, corporate partners, okay, that companies seeking capital, strategic partnership or joint venture in Brookfield's core sectors. Brookfield manage approximately 900 plus billion in assets across real estate, infrastructure, renewable power, private equity and credit. Their institutional client base is global, spanning North America, South America, Europe, the Middle East, Asia Pacific. Here's the asset under management by zone. You have 61% from North America, EME is 20%, Asia 13%, South America 5.4%. When it comes to the market, they have two main, let's say, competitors, which are Apollo Global Management and KKR. Apollo has evolved into hybrid credit private equity manager with significant alternative credit operations alongside traditional buyouts. They've built substantial insurance and retirement services businesses. They keep a traditional fund structure, okay, for profit, but get more and more into long life assets with their insurance business at 10. KKR, it operates across private equity, credit and real asset, but maintain a more traditional private equity centric approach, so they diversified significantly into growth, equity and infrastructure. The more traditional approach is like they have fund from clients, they buy private equity, and after 7-10 years, they get the profit from this and they distribute everything to the owners, okay, the different people that participate into the fund. Where Brookfield is more traditional because they don't aim to sell after 7 or 10 years. They really invest on the long run and then use the profit to continue to grow and to have this higher growth, okay? Like Brookfield really have a way longer term view than Apollo and KKR. It's not bad, okay? It's just a different way. It's what makes them different. Here you can see the different features. For example, the primary DNA for Brookfield is real asset, okay? It's an owner-operator, so they buy a business, they operate it. You have Apollo, which is mostly credit and distressed, okay? They are value-oriented and contrarian. And KKR, it's mostly private equity, leverage buyout. The key platform strength is for Brookfield is infrastructure, renewable and real estate. Apollo is credit and insurance with this acquisition of Athens that they did. And KKR, it's private equity, global buyout. The capital strategy is for Brookfield is operating business. Okay, Apollo is integrating insurance, and for KKR is strong fundraising for diverse PE and other strategy. The value creation for Brookfield is long-term operational improvement is real asset. Okay, Apollo will be value organization, complex credit and merger and acquisition in insurance, and for KKR is operational improvement in portfolio company buyouts. And the insurance role is growing significantly for Brookfield. It's a Brookfield Wealth Solutions. For Apollo, it's very large and central, like it's the main thing for them, and they're leading in this right now. And for KKR, it's a growing part, but historically less central than Apollo. It's not the priority. Here you can see the performance over the last 15, 16, 17 years of the share, and you can see that BN has returned 10.7% per year, where KKR and Apollo return 17% per year. So they're really outperforming Brookfield. So will it continue? We will see in the future, but for now, they're really outperforming. The team, we have Bruce Flatt as a CEO. He is CEO since 2002, and he joined in 1990. And you have Samuel J.B. Pollock, which is the CEO of Brookfield Infrastructure, who joined Brookfield in 1994. You can see that Bruce Flatt owned 3.3% of BN, Jacqueline Cockwell owned 2.28%, and Samuel J.B. Pollock owned 1.3%. You can see that none more so than senior management, we eat our own cooking. It means that 90% of senior management wealth is concentrated in Brookfield. 20% of BN and BAM are owned by senior management. Our team continue to buy more shares in the company. We are heavily aligned in the objective of creating value in Brookfield over the long term. Some numbers here. We don't have the classic numbers that we have in my previous video because it's a different business. We cannot really analyze the earnings and so on. But as you can see here, you have they own 46% of Brookfield Renewable, 26% of Brookfield Infrastructure, 42% of Brookfield Business Partner, and 100% of Brookfield Property Group. Most of them, they are publicly traded, so you can look what is 40% of all of them, and you can understand. When it comes to the debt, they have a corporate borrowing around 14.6 billion and preferred equity around 4 billion, so it's 18.7 approximately billions of debt. And the Brookfield Property Group is estimated to be 24 billion. Okay, so Brookfield Renewable is 6 billion, Brookfield Infrastructure 6.2 billion, Brookfield Business Partner 2.1, and the Property Group 24 billion. Here, the different growth from where it should come. The wealth solution is supposed to grow by 33%, capital allocation by 20%, operating business 2%. Like here's how the 25% cumulative annual growth rate from where it will come, okay, from 33% wealth solution, 17% from asset management, 28% from carried interest, etc. Here you can see that BAM, so Brookfield Asset Management, they own 73% of it, which is worth approximately 70 billion. So when you cumulate all what they own, plus the wealth management, the insurance, which is worth around 21 billion, the direct investments that are around 11 billion, and the unrealized carried interest, which are around 7 billion, you have a total of $145.9 billion. The debt is $18.7 billion. So the net asset value is around $127.2 billion, and the market cap right now it's 93 billion. So theoretically, it's undervalued. BN is undervalued compared to the net asset value. The strength. You have strong long-term return. Brookfield has proven track record of delivering 15+% annual return to shareholder over extended periods. For example, 1 million invested 30 years ago in Brookfield Corporation will be worth 185 million as early 2025, representing an annual return of 19%. Diversified business model. The company operates across 3 core businesses: asset management, wealth solution, and operating businesses, which are diversified across sectors including renewable power and transition, infrastructure, private equity, real estate, and credit. This diversification helps mitigate risk. Disciplined investment and financing approach. The company focuses on investing in high-quality, long-life assets that generate stable, inflation-linked cash flows and employs a conservative approach to leverage and balance sheet management. Significant scale and asset under management. The company managed over $1 trillion in assets as of December 31, 2024. This large AUM provides economies of scale and significant market presence. Global reach on Brookfield ecosystem. Brookfield has significant global presence operating in over 30 countries across 5 continents. The Brookfield ecosystem fosters synergies by leveraging its global presence, the synergies of its businesses, and access to large-scale flexible capital. When it comes to the weaknesses, they have a dependence on key personnel, the ability to attract, retain, and motivate qualified employees, including senior management, is critical. The loss of key professionals could jeopardize relationship, reduce AUM, or impact the ability to source and execute investment opportunities. You have also a complexity of global operations. They are doing everything everywhere. They are in multiple countries, so the regulatory, the legal things for this. They're also managing different type of business, so to have expertise in all of this can be a bit tricky, can include some high risk if they don't recruit a good person and put them at the right place. You have also the execution risk in new strategy and acquisitions. Implementing new investment strategies or integrating acquisitions involves risks, including the possibility that expected results are not achieved, new strategic conflict with existing businesses, or integration challenges arise. You have potential for conflict of interest with various lines of businesses, overlapping investment mandates, and multiple capital sources, including Brookfield's own capital alongside client capital. There are potential or perceived conflict of interest that must be carefully managed to avoid investor dissatisfaction or regulatory issues. The existence of information barriers between certain asset management operations, while designed to mitigate some conflicts, can also lead to situations when investment teams on opposite sides are unaware of and cannot manage certain conflicts and risks. You also have some valuation uncertainty for illiquid assets and even for more liquid assets. A significant portion of Brookfield's investments are in illiquid or non-public assets. The fair valuation of this investment involves significant estimates and judgments, and the recorded values may not always reflect the prices that will be obtained upon actual sale. About the opportunities, they have some growing demand for alternative assets. There is a strong and growing demand for institutional investor, pension plans, sovereign wealth funds, and private wealth channels for alternative asset classes in which Brookfield specializes. They can take private transactions. The trend of passive index investing creates opportunities to acquire public companies that may be undervalued or lost in public markets, offering potential for significant value creation. Infrastructure development and energy transition. The global need for new infrastructure and the transition to a sustainable energy future present a vast pipeline on investment opportunities for Brookfield's core sectors. Their global transition fund strategy is specifically aimed at these opportunities. Credit platform growth. Opportunity exists to further expand the credit platform, including through strategic partnerships like the one with Castle Lake, an asset-backed credit specialist. And capital recycling and reinvestment. Recycling capital from mature assets into new, higher-yielding opportunities is a core part of the strategy to enhance returns. The threats now. Economic condition and market volatility. This is a threat for all the company in this sector, particularly for asset manager. The interest rate fluctuation, especially with real estate and when they have high debt area. This can create some problem, and especially when it's the interest rates are not fixed, that could create problems. The geopolitical risk, the political instability and so on like this can create short-term problems. The competition, the asset management industry is highly competitive with firms competing for investment opportunities and investor capital based on performance, fee, product offering, and reputation. Some litigation, they can be involved in various legal action and disputes in the normal course of business, which could be costly, time-consuming, and result in reputational damage and adverse financial outcomes. and of course some catastrophic events and climate change. We can have a war, we can have terrorism, we can have pandemic, natural disaster. All of this can potentially affect the business, especially the real estate one. If we have another pandemic, Brookfield can be really affected by this. Now let's answer some questions that I like to ask about each business to know if it can be interesting. So as an essential, that's a product of Brookfield, essentials. Yes, people need to invest, but need asset manager to finance infrastructure. Okay, it's not only to invest their money, but some infrastructure in some country and so on, they need to have those private equity firms to finance all of this. Are the sales predictable? Is there any regularity? Yes, it's mostly management fees, so all depend on AUM and the carried interest they will generate. Is it a wide market with ton of clients? Yes and no. Not a ton of clients, but a ton of money, in the sense that you may have a lot of clients, little client, but putting a lot of money. So you have a lot of clients, but you don't have as much clients as Microsoft, for example. Is it difficult for clients to change to competitors? Yes and no. It's easy for clients to give funds to a competitor, but once they invest with Brookfield, they generally keep the money there, especially that Brookfield is a long-term asset. They focus on long-term asset and operating the business. So it's not something where you put your money and 5 years after you just take it out. Generally, you keep it for long. As a product resilient to changes and innovations, yes, generally they are, because it's asset management mostly, so it's not like there is a big innovation in asset management. You may have some innovation in the strategy way of doing it, but generally it's kind of keeps the same. The position. Are they market leader? Yes, in some segments they are. Is the market open or closed? Can competitors enter easily? Both. It depends on the scale the competitor want to enter. Okay, if it's to do some little acquisition of few millions, okay, the market may be open. But if you want to acquire things and go on billions and billions of dollar market, you don't have a lot of competitors. As a price maker, yes, and they price depending on their performance as well. Is it easy to forecast growth? Yes, the management is honest and has an excellent 30+ year of track record. As they dependent on geopolitics, they can be for some project, but a bit like everybody. Is it easy to find new clients? It's easier for them due to their reputations. Management, does the growth come from outside or inside? Both, but a lot from outside with their investment. It's like the policies, they buy business, so technically it's acquisition, so it's come from outside. Is it easy to manage a company? No, they're invested in plenty of different areas, so it can make it difficult. Is the company focusing on creating good products? Yes, I would mostly say they're focusing on creating good shareholder value. Are the important team members good? Yes, they are. When it comes to the moat, Morningstar give a rate of no moat. I guess probably they don't understand the business well, or it's because they analyze it mostly from numbers, and here you cannot really analyze it with the classic numbers and the classic way of analyzing a company. So I guess that's why. When it comes to efficiency, they have an impressive track record, plus 19% per year for the last 30+ years, which is really good. They have some switching costs. Yes, some assets are illiquid, plus generally you don't change your asset manager often. Pricing power, yes, especially on the fees they charge depending on their performance. Intangible asset a bit, but it's mostly their reputation and management team. Like Brookfield brand and Bruce Flatt is like strong, so it can be considered as an intangible asset. Efficient scale, yes, in some markets they are the only one able to enter because of the expertise, or also because of the size of this market. Cost advantage, they can, because they are very big, more than 1 trillion AUM. And network effect, not really this one, but again, the moat here, you cannot really analyze it from the same perspective than other classic companies. Here, most of the moat will come from the management team. To be honest, like the manager create a bit the moat of the company and the culture of the company. This is where the moat is, and with Brookfield is they are investing for long term and with a focus on creating value for the shareholders, and they have a great track record which give a solid moat. Some problems that I would like to highlight about this business. What if Bruce Flatt dies? Can someone take over the company and keep an excellent track record? Okay, or is it going with this? Because generally, like, his name is really strong. So without Bruce Flatt, will the result still be the same? This is important to know. KKR and Apollo have a very solid track record too. The valuation is higher, but can Brookfield Corp outperforms them for the next 5 to 10 years. Okay. When it comes to the guidance for the company, they expect between around 17% growth, and generally they respect their guidance and most of the time do a bit better than expected. When it comes to value, the price now, at the moment I record the video, is around $58. The actual PE, so it's not PE, it's price to distributable earning, is around 17. The forward PE is around 14, and the expected distributable earning growth rate is 17% per year. So let's get on margin website to project the value for this company. So you have, I put free cash flow here, but I took distributable earning, which is 5,171,000,000. So I put this and a growth of 15%. Okay, generally it's between 17 and 20. I put 15%. The price to free cash flow, so the price to distributable earning, I put 18 because for Apollo and KKR it's around 20 or 22, something like this. But for Brookfield it's around 17. So let's say they have a little growth for this. Okay, it's go to 18. You will have a fair value at 62%. Okay, the fair value is not 62%, sorry, $62.5. And you can expect 15% cumulative annual growth rate if you buy around $57, $58. Now let's say they have more. We go at 17% growth and we join KKR or Apollo at 20 price multiple. You will have a fair value at $75 and expected cumulative annual growth rate of 19.49%. And now if they really get amazing with growth, they do, I don't know, 22% growth with a valuation of like a price earning ratio of 20, you will have a 24% expected cumulative annual growth rate and a fair value of $92. If I'm not wrong about this, I think from the report that I read from Pershing Square, from Bill Ackman, they estimated a fair value between $80 and $85 per share for Brookfield Corporation. So I guess they expect a growth rate to be around 20 and having around 18 or 20 of price to distributable earning, which give $85 fair value. So I will keep here 18, and here, yeah, it will be between 15 and 20. So I guess I'm pretty conservative with 15. I don't take a lot of risk with this one. So you have a fair value of $62, which is pretty good. Now it seems to be undervalued. So it may be an opportunity if you like the business. So I give them a 75% as a value score, which is pretty solid, okay? And to conclude this video, I like the philosophy of the company and the focus on long-term gains. I believe that they are, I believe that they are positioned on important markets for the future with data center, with renewable energy, and I think this will be very profitable for shareholders. The way they are managed and the current valuation let me believe that they can outperform Apollo, KKR, and the S&P 500 index for the next 10 years. The price seems to be fair, under $65, and some analysts and even Bill Ackman think the price is fair under $80. So right now, if you like the business and if you understand what they are doing, it may be interesting to invest in the company. That's all for this video. If you liked it, remember to press the like button and to subscribe to the channel, and I will see you in another deep dive. I hope you enjoyed this one, and let me know what you think about Brookfield, if there is any other information that you would like to share or things that you want to add to this presentation like this. The comment section will make us smarter. So I see you in the comment. Bye.